we'll call the pension board meeting to order at 7:03. And thank you all for attending. We have a couple of items to go through tonight, so we'll go right to our agenda. The first order of business is to review and approve the minutes from our last meetings, which was from February 20th, 2020 and March 23rd, 2020. Do you want me to show the minutes for anybody? I can, or has everybody had a chance to look at them?
I'm good. I can make a motion to approve the minutes of February 20th, 2020 as written.
Second.
Okay, any corrections or discussion items?
Actually, was that meeting, that was a meeting we held on Zoom, was it not?
No, the February 20th was a live meeting.
All right. Okay, fine then.
So
You're right.
Any other comments or discussion? So not sure how we do approvals, but well, I guess those in favor, raise your hand or say aye.
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 Any opposed? Any abstentions? Okay, those minutes are approved. Thank you.
Hang on 1 second, Eric. Jeff, can you hear me, Jeff?
Yeah, I can hear you just fine.
Yeah, did you vote on that minutes?
No, I just usually stay quiet.
Okay, so he'll abstain then because he was not at that meeting.
He wasn't at the meeting. Okay, so we have
No.
3 in favor and 1 abstention.
Actually, John sent us minutes from March 23rd, the virtual meeting.
Those are next.
Okay.
That's the next set.
Okay, I'm having trouble getting my agenda up. Okay, thanks.
So next we have the meetings from, this was the Zoom meeting on March 23rd.
Make a motion to approve the minutes of March 23rd.
Second.
My only item is Jeff Fernandez's name is spelled incorrectly. So if we could correct that to an S at the end as opposed to a Z.
Gotcha. With that correction.
And if no other comments or corrections, so all in favor signify by saying aye.
Aye.
Aye. Any opposed? Abstention? Jeff?
No, I'm good. I'm okay. Thank you.
Okay. So motion carries. Next on our agenda is our quarterly investment results from March 31st, 2020. And for this, we have Chris Katchmar from, well, still says Fiduciary Investment Advisors, but I'm not sure if your name is officially changed yet, but Chris, we'll turn it over to you.
Great. Well, thanks, Eric, and good evening, everyone. Good to see folks. I apologize in advance. I'm sitting in a room that faces west, trying to deflect the sunset in the window with the shade. So I think if you see me a little bit in the shadows, that's not intentional. But again, good to see everyone, and we trust everyone is safe and well. A couple of things tonight for discussion. I know toward the end of March, when we had the conversation virtually regarding the rebalancing actions that you took, you'll remember at that time, the portfolio, by virtue of what had happened in the markets in the month of March in particular, was several percentage points overweight equities, overweight fixed income, versus its target. And we took the action, you'll remember, to take $755,000 out of fixed income. 400,000 of those dollars went to equities, and $355,000 were put into the liquidity bucket, if you will, in the money market fund, and are used for near-term pension payment needs and the like. And that's proved to be prescient, I think, for the committee. You met on really the 23rd, which was the absolute trough of the activity, and the addition to equity since then has been accretive to performance in the second quarter, as you can imagine, because the markets have stabilized a good deal since then, and we'll talk to some of those numbers momentarily. So we had sent to John for your consideration. We have our formal big deck, and maybe we can just hit some of the highlights in that. We have an April flash report to bring you up more topically to some of the results in the markets I just referenced. And then finally, we do have a discussion item in the form of one of the existing strategies in the portfolio and an idea around taking action potentially on that investment. So with that, I wasn't sure, I'll defer to the chair and the board. Do we all have ready access to this information? I didn't know if you wanted to share it on the screen or how to best proceed. I was just going to use, Eric, the PDF. It's the 1Q20 QIR. In my email from John, it's kind of off in the lower right-hand corner.
Yeah, I have my copy. I don't know if everybody else does.
I do. I'm looking. I was going to share it. I'm just trying to figure it
Yeah.
out. So
There you go.
did
That's
everybody see that?
Yep, that's it. Great.
That's it, Mitch.
Okay. But I'll try to move it along.
Sure. If you just flip quickly, Mitch, I think it should be the third, 2 pages. There you go, right there, that previous page, if
Yep.
you could. Just quickly, as referenced, so in the midst of all the chaos, we did close our combination with our friends in DeMayo Schneider in Chicago as planned. So we are kind of formally beginning to come together. We are technically still a separate registered investment advisor and still using the FIA moniker for the time being, but that'll change in the coming months. We talked, I think, and communicated to you early in the calendar year some of our motivations for the combination. We're going to double our research staff. We're going to have all kinds of ability to expand and resource technology and operations, and really against a truly global, a global, but certainly a national footprint. And then have kind of joint leadership comprised of members of both firms. So really absolutely no changes immediately for the way we engage with the town. Who you work with, the entire team, myself included, is going nowheres. And any changes that we may bring for your consideration, of course, will be done thoughtfully. Will kind of represent the best interests of the firms collectively. So it's pragmatically a non-event for the foreseeable future, but we'll certainly keep you posted along the way here. If we, Mitch, jump ahead to the governance section, you know what I can do here? Bear with me.
You have
if
a
you
page
don't
number
mind.
for me?
Yeah, there you go. If you go to the next page in the exhibit, then the next page. So here's the fee exhibit, right, that we like to look at each year, just as a reminder for us collectively of the fees being borne by the program to administer to it and to set it up for, I think, all the services that we need and what we're trying to accomplish longer term. So as you know, right, the portfolio, the bulk of the expense comes out of the fees of the investment managers. And you see there is exhibited a little less than 0.5% of fees come out in the form of investment management. We spend a lot of time thinking about the fee construct, and we use institutional funds, cheapest availability that we can get. We mix some indexing in, as you know. We're really conscious of those fees. And I would tell you our assurance would be that when we look across your peer communities across the state, given the complexion of your program and the type of strategies you're using and size and whatnot, this would be a very representative competitive fee on the investment management front. And I think, as you know, as a subtle reminder, all the return numbers that we look at in the reports are net of that investment management fee. There are ancillary fees elsewhere, right? There's the Wells fees for custodial work. There's the FIA fee for full retainer consulting and advice. And I think, again, if you aggregate all those numbers together and you do the arithmetic, right, you're at, 62 basis points, something like that. I think all things considered, a competitive fee construct for the programs. So that's just our simple reassurance that we like to do once a year and catch up on that front. If we scroll, Mitch, ahead, not really anything to take away from this page, right? I know you had a recent conversation with the Milliman folks around some of the different considerations on mortality tables and the like. This is just a visual reminder, right, on the data, where the returns are and funded status and whatnot. I don't think there's anything actionable here necessarily. It's just more of an FYI thing that we capture and keep tabs on. So that is that on that front. If we jump, Mitch, keep going ahead here. Let me see. I guess the last thing on this front on page 10, right? Just a quick update here. So I think, John, you and Audrey are hearing with some degree of frequency from the service team at Wells, now principal. We spend a lot of time talking to them directly as well, as you know, and monitoring that transition. It sounds like, from what we can tell, all the RMs and people you're accustomed to dealing with won't change whatsoever, and that principal is adopting the Wells Fargo platform and engine, if you will, behind the scenes to do custodial work. This should be, I think, a relatively straightforward transition with no hurdles, but we'll keep you posted as we learn more. But everything we've heard today has been constructive and is kind of on schedule for an orderly transition. I don't know, John, if you've heard differently or elsewise, but feel free to jump in.
No, I believe everything's going well. Audrey hasn't told me about any problems she's had with them, so I'm sure I'd hear about it if there is.
Right. Yeah, I think it's in pretty good working order. If we forge ahead here, Mitch, to let's see here. Maybe we'll stop here for just a minute. So this is becoming a little old hat, right? I know you've heard this from us at the end of March when circumstances were particularly dire, but just recapping the full quarter. Remember, we began the year with this, I suppose it's a silly notion now, right? But we had an accommodative Fed. We had a trade deal between the US and China. We had corporate earnings that were stabilizing and even in some cases starting to grow overseas. And there was this idea that while the recovery and the economic expansion cycle was a fairly mature one, that we could have the makings for an okay year in the capital markets, given the circumstances. Valuations in markets were full, but we don't think that they were outlandishly expensive. And obviously the crisis has turned this dialogue completely on its head, right? So we are now certainly no doubt in the midst of a slowdown and a recession with dramatic downdrafts in things like industrial production and retail sales. And you've all seen the unemployment filings and the like. So circumstances are pretty tough right now in the broader economy. And that associated, as you know, with a pretty rapid re-rating of equities. And you see the downdraft there in summary fashion in the right-hand corner of the page, upper right-hand corner. So what's happened more recently, or what's been the basis for some of the stability, I suppose, on a relative basis anyways, and that's been that the authorities, right, have said they're prepared to basically throw any and all forms of stimulus at the situation to try to keep things somewhat under control, and starting with a CARES Act, north of $2 trillion, which is far reaching. And I know you've read about the implications and what's going on there. The Federal Reserve cut interest rates, right, to zero. There's all kinds of liquidity facilities that they've put in place into the different segments of the fixed income market. So it has been all hands on deck. I think if you do the arithmetic globally right now, there's something akin to $17 trillion of stimulus that's been pledged. And that has certainly given investors a degree of comfort anyways, more recently. On page 12, the next one, the unfortunate outcome, right, is start to finish for the quarter. It was tough sledding, as you know, right? So you see there in the top half of the page in the upper left-hand corner, the equity markets across the world were universally negative. Fixed income markets were on the surface positive. You see the broad market index there at about 3%. But I would caution you that most segments of the fixed income markets, investment grade credit, high yield, other areas where managers were finding value before the crisis, performed pretty poorly as well, like equities. And it proved to be a pretty challenging benchmark for the active and fixed income managers to match. And it has predominantly government and treasury securities in it. And given where interest rates were as the year began, you can appreciate, given how low they were, managers didn't have a lot of appetite to hold that kind of paper. If we, Mitch, scroll ahead here, I think in the interest of time, given some of the things that we've got to do, I would skip 13, 14, 15, 16. I would stop maybe on 17, if you would, please. Go to 18. I'm sorry, Mitch, now that I think about it, if you would. Thank you. Perfect. So this is just a recap, right? And it's kind of an interesting visual. We actually borrowed this from our new colleagues in Chicago at DeMayo. It catalogs on the top half of the page visually prior bear markets, right? And a bear market definitionally is a 20% decline in equity prices from peak to trough. Look at the it's not labeled, but the horizontal axis on the top, as you can imagine, is time. It usually takes about 3 months for a right to be counted as one, if that makes sense, right? To have that magnitude of a decline. In March, it took 16 days for the bear market to take hold. And you see that lime green line in the upper left-hand corner there, how dramatic the re-rating in equities were, and the pace at which it happened, which really was unprecedented. So it was really an outlandishly difficult quarter, and particularly the month of March. We had conditions in the capital markets similar to what we had back in the 08-09 crisis, where the Fed and the government really had to come with their A game and lots of tools and firepower to keep the markets functioning for a couple of days there in the middle of March. But they are functioning much better now, as I mentioned. Bear markets do come back, right? So you see there the previous incidents that we tabulate on the top with the benefit of time and some stability. We've circled it there with the oval in the far right. You can see markets do re-elevate and typically do so in pretty significant fashion. Of course, the jury's still out on this one, but we are up, 30 some odd percent in the S&P 500 since the lows in the the middle of March timeframe. So we've had a pretty good March back already from those low points. So that is it. Is there anything just on the quarter before we put throw that in the closet and forget it ever happened? Did anyone want to visit any of the first quarter? Happy to do so, but again, really just a difficult quarter on all fronts. Sounds like people are okay.
Yeah, I think we're good, Chris.
Okay, thanks, Eric. Let's, if we could, Mitch, if we go forge ahead here, we'll skip the preferences page if that's okay. So here's the portfolio at the end of March, $21 million. So you do see there, interestingly enough, right, just as a reminder, I know I mentioned it already, but when we had our Zoom meeting back on the 23rd of March, fixed income at the time, you may remember, was about 45% of the portfolio. So it was almost 7% overweight the target. And you'll remember we trimmed down a good portion of that, not all of it, but a good portion of that and put some of that back into equities. And again, you see there was some money that was carved out in liquidity for near-term pension payments to be made. And we'll show you those updated balances for April in just a minute. The three things, because we're on this page, that I'll remind the committee of, just in terms of statuses, this is a good visual place to do that. The bulk of the lineup continues to be on maintain and in good working order. We do have American Beacon, large cap value. You see in the middle of the exhibit there, you may remember we put them on watch last quarter, the fourth quarter of 19. There were some changes under the hood in the collection of sub-advisor firms. I can get into the details, but I'll refrain from doing so. But there was a dismissal of one of the four sub-advisors, and the other three managers that remained were proportionalized. And it was enough of a change for us that we wanted to kind of elevate and watch that particularly closely. And we'll keep you posted. We don't have an action item recommended, but we did want to remind you of the status there. And then if you move down the exhibit further, you'll see the Templeton Institutional Foreign Small Company Strategy in the international segment, equity segment of the program, went on watch last fall. And you'll remember, not for performance reasons, because performance has been pretty solid actually, but there were some retirements. Their global CIO retired, their research director retired, and they re-resourced, if you will, or reorganized the research and analyst teams. And it seems to be going fine, and they haven't really missed a beat on the performance front. So I suspect they'll come off watch in short order, but we wanted to keep them on one more quarter anyways. And then I'm going to set aside Morgan Stanley. We did elevate them to terminate. I know we sent some collateral out to you last month. Eric and I had occasion just informally and briefly to chat about it. And we do want to bring that action item back to you momentarily, but you'll see there Morgan Stanley down at the bottom has been elevated to a terminate status. And we'll talk to that in just a minute. If we skip Mitch ahead to the next page, really, there's not much I can say constructive about this, quite frankly. It's the first time I remember in all the years we've been working with the town and the committee where it was just a quarter that there wasn't a lot of good stuff happening at all, really. So you see the performance there for the plan down about 16%. It did lag a bit, the broad markets, and we'll talk to some of those reasons why momentarily. And again, we've seen a nice recovery in April, fortunately, but there was no hiding or escaping from the freight train that was the declining markets, and a difficult quarter for active managers all the way around. Within the program, the fixed income managers in particular, as I alluded to earlier, had a really difficult time of it. MetWest, Western, and BlackRock all struggled a bit in the quarter to keep pace with that government paper heavy index. They just weren't positioned there. Our litmus test, right, for them and our proof statement and our confidence in them going forward is that now that markets have settled down in April, they're handily outpacing the benchmark again, which has been their longer term direction and orientation, as you know. So that is it for kind of a nutshell. I know I want to be sensitive to time, and we've got a couple other pieces of collateral for you to look at. And I do want to get to that, but let me pause for a minute. You see there $21 million at the end of the first quarter. The end of April, I think we are up about $1.3 million, $22.3 million as of April 30th. So we have gained a good deal back, but it'll take some time to fully recover, no doubt. Anything from the committee on the quarter? Touched a little bit on the merger, governance, the bigger picture market backdrop, and then a little bit on performance in the roster of managers and the allocation. So I think we've kind of covered the big pieces. If no one objects, Mitch, if we could go to the April flash.
Look, I just have a quick question,
Oh,
if I
sure,
may.
Barbara.
Would you be recommending allocating more to large cap value if American Beacon was not on watch status?
Oh, great question. Let's go back. Can I, Barbara, ask a favor? Can we do it with the April numbers?
Absolutely.
Because they'll be more updated, so it'll be a more topical for us. But that's a good question, so we'll definitely tackle that. So somewheres I know, John, right, in what you sent around, there was, oh, Mitch is quicker than I am. Okay, great. So you see here, just quickly in condensed fashion, right, what I mentioned earlier. So a much better operating environment in April, right? So you see the month to date in the upper left-hand corner, the S&P is up almost 13%. The other major components of the markets are up double digits as well, uniformly so. Decent, not quite the same pace, but decent returns in the international markets. You see that in the upper right-hand corner of the page there. The broad markets are up a little north of 7.5% internationally. And then in the lower left-hand corner of the page, you do see fixed income still pressing along, right? Interest rates have been reasonably well behaved, and the broad markets were up a little less than 2% last month. And then you do see there under the hood though, right? If you can make it out, the corporate IG, which is the investment grade paper, and then the high yield paper, look at the incremental returns there versus the broad market. So as I mentioned earlier, again, it kind of a creative stances and places that the fixed income managers in the program are focusing on. And that has been, fuel for the much better results they've had in the last 5-6 weeks. So that is a quick recast of April. If we Mitch forge ahead here, we should have the next page. We should have the portfolio layout. If my memory serves, patient detail. There might be page 3, maybe. Now, other direction, where next page. No, did I? Let me look here. There should be an allocation table. I wanted to Barbara's question.
Page 5.
First. Is it? So there's a. Oh, there it is. Yeah. I guess we. You know what? I guess I'm just. We do reorient these in the other direction. So anyway, so here is the portfolio at the end of April. There's the $22.3 million we talked about earlier. We've still got a little bit in the bank for liquidity purposes. You do see now, right? Look at the fixed income category, and the weighting there is gravitated, as you would expect, right? Back down into that 38% target. And the other percentages are relatively close as well. Barbara, I think the answer to the question is we would not be putting more money right now into American Beacon. Remember, we talked several quarters back about accentuating the value style domestically a little bit because the dislocation in performance has been so severe. So that's why it sits as a slightly higher percentage at the target and actual level versus Harbor, your growth manager. But I think we've got plenty there now, and there wouldn't be a call from us to do more right now, even if American Beacon was not on watch. Does that help?
Yes, thank you.
And then I'm sorry, Mitch, I had screwed it up. And then if you scroll back, you'll see, as I mentioned earlier, a much better month for the plan. So we're up about a little shy of 8%. You see in the upper left-hand corner there, a 7.7% return, and a bit ahead of the benchmark, which is encouraging. And the longer dated numbers starting to, gravitate and pivot back where we expect them to be net of fees, at and above benchmark. So I think we're in pretty good working order there. Let me pause though and see if there are any questions from the committee as to the month of April.
Chris, this is Eric. I have one question. Well, it's probably a multi-part, but with the way the market performed in the first quarter and then came back in April and into the beginning of May, should we also be expecting that sometime going forward that there's not going to be this smooth of a recovery, that there's a likelihood that there will be another dip? It could be very severe and we just have to kind of wait that out?
So it's a great question, Eric. We all would love to know the answer with precision, right? Because we could all run away to a Caribbean island and we wouldn't have to fret over it. It's a great question. My answer is probably going to be somewhat unsatisfactory to you. We certainly do have a central forecast and an expectation that markets will continue to bounce around here. We certainly don't think we're out of the woods just yet, right? The economic picture is much too dour right now to expect that we're just going to march forward here and continue to re-elevate consistently. Whether we test the conditions that we had in March again or not, that's not our central forecast, right? That was a god-awful period in the markets. I think that investors have digested in some form or fashion the magnitude of the crisis, the potential implications, the work that needs to be done, right, to kind of dig back and set the economy up to grow more consistently. And we think a lot of that was baked into that March activity. The markets could have run a little bit ahead of the economy in the second quarter to date. That could be a fair statement. And we could see, a couple of periods of retrenchment, where we move down over the course of a week. I don't know what that number is, right? It could be 3% or 5% or maybe even 10%. What we do know, right? Like we saw that in that collateral earlier, markets do ultimately regain their footing, and investors do ultimately get compensated if they can be disciplined and patient and bear some risk. Equities go up, bond prices over time go up. And if we can kind of grit our teeth and fight our way through some of these weak spots, we do know that the program you've got in place, right? If we step back from all the manager detail and chatter, you've got lots of diversification. You've got reasonable costs. You've got managers who longer term, by and large, have demonstrated track records to add value. I think we can collectively hang our hat on a lot of those attributes and all the work that this board's done previously to kind of guide us through it, if that makes sense. I don't know if that was too hot-winded or not, but that's the way I would think about it.
Yeah, no, that was good, Chris. The other thing I wanted to just point out to everybody, and Mitch, you're on the right page for it, is just to look and because we do have up years and down years, as you can see, but over a 10-year period, we have a return of 6%, and I think this just reinforces what we've been doing over the last several years of lowering our expectations from an actuarial standpoint as to expected returns, so that we're aligning it probably a lot more with where kind of reality is setting in, and we're not way far off from what our results are, but short of a very bad first quarter, we'd be over a long term probably doing better than what our kind of assumptions are. So I think looking at this, we're on the correct path for what we've been doing over the last several years.
Eric, I would totally agree. We've been trying to stay as much as we can, as gradually as possible, to lower the assumption rate. We've done a much better job than many of our sister communities, certainly much better than the state of Connecticut as far as the assumption rate goes. And there were times where I was a little skeptical because I said we're beating that most of the time, and we were back and forth. But this year is really gonna gonna correct things the wrong way. So I think the fact that we lowered our assumption rate is really a good thing, and it will help us tremendously in the long run for what our yields for the pension fund.
Yep. Thanks. Any other questions for Chris on either the first quarter or the April update?
The only thing, Eric, I might do it as a transition into the discussion on Morgan Stanley, if you wouldn't mind again, Mitch, on back to page 6, I guess it is here, just so we can see, as a reminder, that previous page you just had there, I'm sorry, was it, I'm screwing everything up. There we go. So just as a reminder to the board, right? So you see down at the bottom of the exhibit, we've been running REITs as a category, a little bit light of the target. That's been conscious. It's also a byproduct of some of Morgan Stanley's performance woes more recently. So you do see there, right, about $890,000 of the portfolio balance in REITs. We continue to like REITs as a diversifying tool and as a differentiated return source for the program versus the equities and fixed income that make up the lion's share of the portfolio. We get lots of question, right, and inquiry from boards like yourselves on don't REITs mean real estate, and doesn't real estate mean that, you know, no one is leasing businesses anymore, and that retails and malls are shuttering up, and why would we want to be in that? And you'll remember, you all know this, but as a reminder for us, you know, real estate is a pretty all-encompassing category. And if you look at things like storage and industrial properties and leasing and build outs of healthcare facilities and other things that REITs can and do invest in, and strategies can invest in, that we think there's still a lot of compelling opportunities for a you know, kind of a disciplined, thoughtful manager. So we still like the category. Morgan Stanley, unfortunately, we think has kind of lost its steam. Their lead portfolio manager for the U.S. portion of their global strategy that you're in left the firm a few weeks back. That's categorized in the termination letter here that we had sent out, BJ Grant. No plans to replace him. They've had to kind of reconfigure the coverage under Ted Bigman. So you've got all those changes going on. And then moreover, you've got performance now that has persisted weaker than we think it should have been for a more extended time frame than we think it should have been. And captured in this memo from our research group is, as you see there at the top, is labeled a terminate status. And again, we like REITs, think we should continue with REITs, just think we should do it with a different manager. And with that setup, if you look, Mitch, you see right next to it there, it looks like on your banner, CS versus MS there is the study. I know you've seen these studies from us in the past, right? This is just where we capture all the information. Again, apologize that the font here is small, but Cohen and Steers is a long-standing equity manager. In fact, in many ways is kind of the grandfather of the category. They're the largest dedicated REIT manager and really cut their tooth in that space as a firm many, many years ago, and continue to be a forceful presence in the space. And this is a strategy, again, similar to what you do with the Morgan Stanley one, that is a truly global footprint. And overseen and administered by an experienced group of investors led by John Chi. Lots of fundamental analysis, orientations in the program away from some of the troubled areas that we mentioned, right? So they are very light in things like retail and malls, and tend to focus on residential and industrial and healthcare. And just a really kind of capable, long-standing manager in the space. You see there 90 basis points is the fee. Morgan Stanley right now is 92 basis points. Well, there'd be a little bit of a savings, not much if you decide to move. But just a good, credible team, and one that is, you know, a fully unfettered expert in real estate, if that makes sense. If you scroll, Mitch, down just to look at a couple of the high-level numbers, and we won't drag you through too much of the detail unless you want. What we do on this page here, as we've done in the past for you, we just show you a simple comparison of the return streams of Cohen through the end of March versus Morgan Stanley, the incumbent there. And it, you know, sometimes you have to be careful with these type of rolling numbers, right? Because the recent performance can really skew longer term data. But clearly you see here in the case of Morgan Stanley that those numbers are weak enough near term now that they've really started to infiltrate their longer term track record as well, which not too long ago, 3 or 4 quarters ago at most, was still a very strong one longer term. They just haven't been able to work their way out of some of these issues. So Cohen, compares pretty favorably there. If you skip, Mitch, to the next page, you see the calendar year numbers. If you do the arithmetic there, I think Cohen and Steers outperformed 7 of the 10 years, if I did my math correctly earlier. So there is some degree of consistency in the portfolio, and they've done it, if we were to dive really deeply into the statistics, with consistently less risk than Morgan Stanley also. So the recommendation that we have for the board tonight would be consideration of keeping REITs, but swapping those monies directly into Cohen and Steers, and away from Morgan Stanley as the incumbent manager. And then I'll pause in a minute. The only other thing I'm obligated to mention, it's listed on the front of the report, but I should mention it so it's clear to everyone. Cohen and Steers is a client of ours. We actually, it's not my client, but one of my colleagues actually provides advisory services to their retirement plan. The only remuneration we receive from Cohen and Steers is that you can appreciate, right, is strictly the advisory fee we get from them for those services. There's absolutely no financial relationship or considerations for using the fund, for not using the fund. They're agnostic, we're agnostic. We like the strategy, just as a good, experienced, a well-regarded REIT manager. But I am obligated to mention that to you just so you're aware of it. But again, there's no financial relationship whatsoever other than the fee for service. And that's kind of a quick recap of the thought in that space. And I'll pause there and see what type of questions the board might have.
I know, Chris, when was the last time you recommended a change to somebody who lost 24% in the last quarter? It's looking good.
Yeah, well, yeah, I know, Mitch, it is tough, right? So REITs did certainly get wrapped up, right, in all that noise. They tend to have a little bit of a smaller capitalization profile to them, right? So while the S&P we talked about earlier was down right in the quarter, close to 20%, I guess, start to finish. Smaller cap names were down even more.
Yep.
Certainly REITs kind of fall into that category. So they were painted with an indiscriminate brush too. We still think it's a good place to find differentiated returns and get some yield in the portfolio. And it's 4% of the program, and it's certainly a lot of money for all of us, but it is 4% of the program, and I think it's kind of thoughtfully sized otherwise.
Does anybody have any other questions for Chris on the Cohen and Steers presentation? So if none, I'd entertain a motion of a recommendation from Chris of transferring the assets from the Morgan Stanley real estate fund to the Cohen and Steers.
Motion to liquidate the position in Morgan Stanley Institutional Global Real Estate and invest the proceeds in Cohen and Steers Global Realty.
Is there a second?
I'll second that.
Okay, thank you. Any other discussion or questions for Chris or anything else?
Seems pretty straightforward. And I think appreciate the analysis that was done and, having, Chris look at this and recommending this change at this time. It sounds like the prudent thing for us to be doing.
Yep. So, okay, if no other questions or comments on the motion? Those in favor signify by saying aye, raise your hand.
Aye.
Aye.
Jeff? Okay, thank you. Any opposed? None? Any abstentions? None. So motion carries unanimously. So thank you very much. Chris, appreciate your effort in getting us all this paperwork and analysis, because this has been very helpful. And other than that, is there any other business that we have to bring before the board?
Just to wish Eric a happy 60th birthday this week.
Happy birthday.
Thank you.
Happy birthday.
It comes around once a year, whether I like it or not. So one question for John before, and you may not know the answer before we adjourn. Our next meeting, John, is scheduled for August, which at this point, we don't know whether that's going to be Zoom or live, but typically at the August meeting, we've had representative from Milliman present the actuarial information. I don't know if because of situations they're behind in what they're doing, they're still on target, but we'd like to have them be able to come to the meeting if, virtually or live, as the case may be. So if you could check on that, or if you know of anything right now, that's,
I will check on it. I haven't heard otherwise,
Okay.
so I will make sure.
but, just in case if they feel that, they need an extra week or so and we need to move the date, we can look at that as well. But, I'd like to make sure that we're kind of staying on point for that if we can.
I have one other thing before we adjourn. Paul Denise's spot. Does anybody know where we could find some information on how that came about?
It's strictly recollection, because this goes back, 20 years, when the employees union, my understanding is the employees union won a arbitration decision that included placing a member of their union on the pension board. Now, and the police have the same thing, although I'm not sure if the police was done by arbitration, but certainly that's why Jeff is here as a member of the police union. But as we've discussed before, is there anybody else who's a current member of that group that's even in the pension plan, John?
No. That's why Vinny and I had a discussion about this today. I had talked to him about it after our last meeting, and quite frankly, I forgot and he forgot, and we spoke about it today. And he's of the opinion, and he's going to look a little further, that it's maybe just up to the first selectman now to make an appointment, that it doesn't even have to be out of that union, since nobody currently is in the pension plan from that.
I don't think it necessarily, and back then, everybody was in the pension plan. So I don't think it necessarily has to be someone in the pension plan. We've had members of the police department who are not in the pension plan that serve on this committee. However, my suggestion would be to you, to give to Vinny, is just to have a one-page memorandum of understanding with the leadership of the union, just saying, just because no one is willing to serve on the union, that they are vacating that spot to an appointment of the first selectman. And then there's no question, there shouldn't be any grievances, there shouldn't be any issue there. If they feel otherwise, then somebody should step up and say they're interested in serving on this board.
Did Vinny have any idea if the latest CBA superseded that arbitration result? Because I always thought that a CBA had a supersedious clause that said all prior awards, agreements, etc., are superseded by the new CBA. For what I understand, there's nothing in the new CBA that would allow the position.
I don't think there was ever anything in the CBA. I think even when it was awarded, I think it was a separate side agreement. Whether it's, like I say, John, you have to go back to many years ago.
Who do you think, we were talking about who the attorney might have been then? Was it Floyd Dugas?
No, it was
So it was even,
probably Mike Dorney.
oh, so it was even before you and
It was,
Sousa then.
it was when I was on the pension board. I may be wrong. I'm guessing when Dot Berger was first selected.
Mitch, I think you're right, though, as opposed to trying to go back in time for this, maybe the best thing is go to the union leadership and just say, that there isn't anybody participating. There is, unless there's somebody that they can recommend that does want to participate. Our recommendation is to, have the first selectman appoint somebody else so
Right.
that we have a member of the committee that's going to be active and participate.
Right.
And, if
I think that's the best approach, John. That way you don't,
Okay,
it saves the time from even going back and researching it, because I don't think there's any fight from the union that's going to say, no, we want that spot, because we've had such a hard time finding somebody to serve anyway.
yeah,
So
well, you
the union
gave
has
me,
somebody that's interested, then let's move forward.
you gave me an idea though, since it goes back to Mike Dorney. Dave Ryan worked under Mike Dorney at one point. I'm gonna jog his memory and see if he remembers anything about it.
Okay.
Also, it's worth one last shot.
Sure. You got till August.
Yeah.
Well,
Government doesn't move that fast.
yeah. Well, hopefully before August, because, if we want an appointment, if possible, to get somebody appointed for the August meeting. If
That's what I meant. That was my intention.
No, I understood that.
And John, one other question, and just more of from a planning standpoint, and just so Chris is aware also. Typically, and because this will come up between now and our next meeting, typically the annual pension contribution has been made, during the month of July. With all the economic issues and everything from a cash flow standpoint, is that still the plan of the town, or is that going to change at all?
It's my plan, depending on what the tax collection is going to be.
Sure.
We're pretty worried about that, and along with the 90-day extension that some people have.
Yep.
No idea.
Okay.
But that is my intention. Unfortunately, July is a big month for money going out first time. A lot of the bonding and interest, principal and interest is due that month. Rather big payments to both the school systems that month and the pension plans. But it is my intention, if we can
Okay.
collect enough, it will go out.
Yeah, my recommendation is just that if you could keep Chris and his group informed, because we just did a cash raise for June.
I saw it.
But when we get towards late June, I don't want to have a cash raise and then the money coming in and kind of duplicating, but I also don't want them to assume that, oh, the money's going to come in, we're having some, cash flow delays, and then we get caught, running around last minute, around the 4th of July or something, trying to
Yeah.
raise money.
Well, probably if you're going to need money for the 1st of July, you're probably going to have to do it, because I probably won't have money coming in, and I probably won't know until the middle of the month, and the payment will probably go out towards the end of the month if we get the money in that I hope to get in.
I think the raise we did today probably should be sufficient for the June and July payments. Chris, I know you don't know right off the top of your head, but the numbers just looked about that way to me today.
Yeah, I think you're right, Eric, with what remained is residual right in the money market prior to the raise. And with what you did today, I think you're right. We should have enough to get us through.
And I certainly don't want to miss the bump going up in the market if it's starting to take off at that time with everybody back to work. At least we could hope.
Absolutely. I understand either way. My recommendation is just that we make sure that we communicate all the way around between us and Chris so that we're all on the same page. That's all. Because I know it is probably expected to be a difficult quarter with everything going on and kind of an uncertainty as to tax collections, et cetera.
Mhm.
So-
Chris and I will talk.
Sure.
We're both in early.
That's right, John.
Not a problem. And if you have your Munis system in, you'll be able to actually wire the money as opposed to sending a check.
That would be nice too.
So any other items, comments, questions, items to bring before the committee? If none, I would entertain a motion to adjourn.
Motion to adjourn?
Is there a second?
Second.
Any other questions? If none, all in favor, it's at 7:59.
All right.
All right.
So meeting is adjourned. Thank you all very much for attending and participating.
Good night, everybody. Stay
Good night.
safe.
Well, everyone.
Stay safe. Bye.
Thanks, Ann.
Take care.